All right, today we have a stock analysis of Microsoft. So Microsoft is one of the more popular stocks right now. It's always been popular, but as of recent history, they've not been the most popular stock that people are talking about. On the radar, but not discussed as much. And that potentially is a buying opportunity. When a company is doing well, they're established, yet they're just not the darling of all the market attention. At the time, you can see that stock slide, and maybe there's some value there. So that's why we want to look at this stock right now. And recently, they've answered some questions that a lot of investors have been excited to hear about. We've been chomping at the bit to find out of all of these companies, these hyperscalers that are investing billions into data centers, who is going to start reporting a return from all the billions being spent. And Microsoft, along with Amazon, are some of the first companies to kind of show significant return on investment based on all the billions that they've been spending and putting in the data centers. So that's what we're seeing here. This is directly from their 10K that came out recently. Their cloud revenue increased 27%, and their backlog, their remaining performance obligations, meaning the orders that they're bringing in that they haven't started yet, that they haven't earned this revenue yet, but their orders on their books that they're waiting to get started increased 84% to 678 billion. These are some of the things that investors have been looking for. When is that return going to show up? And with Microsoft, we're seeing that return starting to come in. So we like to see that. And of course, like I said, with all the questions around all the spending, we're finally seeing some results right here. So look at the 5-year chart for Microsoft. Right now, stock is trading at $503, a little bit over. And we see this downtrend and this spike right here because of the recent news of their 10K and the increase in cloud revenue. So this is why a lot of people have jumped back in, putting it around all-time highs. But we want to know, even though it's at an all-time high, is the stock properly valued based on what we project the company is going to do in the next 3 to 5 years? So we're going to look at that right now. The PE, they're trading at a multiple of 28. Not the most egregious multiple for a company of this caliber. Also not the lowest multiple that we like to see when it comes to making sure we're investing at proper valuations. So we see a dividend of about 0.72%. So let's look at the fundamentals of the business, look at the revenues and margins, and seeing how they've been progressing over the past 10 years. To see, is this something that we may be interested in as value investors who are looking to put money in a long-term investment and sit back and relax and allow our money to compound and make us rich. So let's look at this right now. Looking at their business segments. This is how their revenues are split. We'll look at the most significant categories right now. We have the service, products, and cloud business. 39% of the business, that is their largest segment. So this is Copilot and Azure. This is a lot of their cloud services and AI computing segment here, 39%. And the fastest growing segment at that. We have the Microsoft commercial products. So these are all the businesses that have Microsoft Office and use, the Outlook, Word, Excel, 31% of their business. The consumer side of that is only 3% for those that were wondering. We have LinkedIn coming in at 6% of the business, Windows at 5%, Xbox declining, but at 6%. And we have search and advertising at 5%. Those who use Microsoft Edge or Microsoft Bing, I should say. Search and advertising, 5%. So that's how their revenues are broken out. Let's look at their revenue trends. How is this company growing and how are they sustaining that growth when it comes to their margins? Let's look at 2017, $96.5 billion, 2026, $331 billion. So we see they only had 2 years of single digit growth. And every year this, dinosaur established company is growing at double digit growth every year. And 17.8 this past year, which is one of their highest growth rates other than, 2022. So they are growing at consistently 15, 14, 17%. And the growth is getting stronger with the cloud revenue that we mentioned earlier. That's what we like to see. Over the past 5 years, they've averaged 14.6%. Now they're projected to grow at about that or a little bit more over the next 5 years, with continued investment into data centers and AI infrastructure. So with that said, let's look at the gross margins. We want to see, for every dollar that you bring in, once you cover the cost that it takes to deliver the product or service to the customer, how much is left over. So we see margins 64% and increasing 68, 67%. So consistent margins and growing incrementally year by year. So we like to see established businesses grow their margins. We like to see them either hold or grow them. And they are pretty strong margins that are holding pretty steady and even growing a little bit. So we like to see, so every dollar that they bring in, they have 67 cents, almost 68 cents left over this past year after the product is delivered. Now, looking at net income, once you cover all expenses, what's left over? We have a 26% margin here and 40% margin here. So this is amazing. I would say this is their down year here in 2018, 15%. But to go from 26 to 40% means they are becoming more and more efficient. So for every dollar that they bring in, Microsoft is holding on a claim to 40 cents of total profit that covers or that's left over after all their expenses are paid. So that's where they are. Very strong margins, very consistent, and strong revenue growth for a business in the mature state that they're in, even though, like some of the other businesses, like we see with the Google and Amazon, certain parts of their businesses are established and other parts of their business are pretty new when it comes to the cloud structure or the cloud support servers that they have. So looking at their balance sheet, we want to see how fast the company can pay off their debt. We're going to compare their debt to their free cash flow. With the caveat, this company is investing heavily into AI infrastructure. So their cash flow isn't as strong as it would be without those investments. But we still want to see how healthy that balance sheet, what's the balance of what the cash flows are versus the debt balance. So looking at the debt, over the past 3 years, they averaged 97.8 billion from 83 to 109, which makes sense with more investment into the data centers. And we see cash flow averaging for the past 3 years, 70.8, starting off at 31 and going all the way up to 66.9. And this is after the data center investment. They're walking away with 66.9 billion in cash flow, staying pretty much under 2 years since 2019. They can pay off their debts with their cash flow in 1.6 years, averaging 1.4. This is great leverage, which means they have a healthy balance sheet. Now, I will say, when it comes to the data center infrastructures that they're building, this year, Microsoft committed, I believe, $36 billion to that. It's not on their books. It's not in their debt because it's construction in progress. So what happens is when the company is building something, whether it's a building or in this case, the data centers, the money that they're putting into it goes into this category called construction in progress. It's not in service, so it's not earning revenue. So technically, based on accounting rules, it's not going to be placed on the books. So some companies are more, I say, more upfront in disclosing what's in their CIP, their construction in progress. Other companies are not so forthright with it and are kind of keeping that secret because they know some investors may not be happy with the number that they see. So you have to go through the financials and get an understanding of what they've been committing to these projects, because that is future debt that's going to be on their books. But the idea is that that future debt will also lead to a greater cash flows to service that debt and fund the future of the business. So that's the idea there. Dividends. Looking at their dividend real quick, because Microsoft is a tech company with healthy cash flows, but they have opportunities to reinvest a lot of those cash flows back into the business. So this is not a company you would look for a super high dividend from. But with that said, they pay out 29% of their cash flow in dividends right now. With growing that every year, we see 9.6, 10.2, 10.6, 9.6. So The dividend growth, even though the dividend is still kind of small, 91 cents per share per quarter, that's not a high dividend. However, that growth is pretty strong. So right now they're operating as if they could be a dividend growth stock. But again, with the data center investment and the nature of the business, within the next 5 or 10 years, there's going to be some new craze that's come along, new technology, and they have an opportunity to strengthen the enterprise by reinvesting into that new technology. I wouldn't expect this to continue to be the case. It could be, but it might not be. So this is just an extra benefit, this high growth for an investment like this. A company like Google would not be paying a dividend or not be paying a strong dividend like this because of their rate of reinvestment in figuring out what new technologies they can take advantage of. So again, 91 cents per quarter for this stock. Lots of room to grow if they ever decide to grow that dividend and continue to grow it at this rate, because only 29% of their cash flows are being paid out right now. Dividend yield 0.71. So not a high yield, but the growth is more important than the yield all the time. Let's look at the shares outstanding. We want to know, with your free cash flow, are you taking some of that free cash flow and adding value to the shareholder by purchasing shares, taking shares off the table? And when you do that, you're increasing the value of the existing share. So if I buy the stock and I hold, is this an area where I'm also going to be rewarded beyond the dividend? Try that again. So looking at the share count, well above 7.7 million shares in 2017, down to a little bit over 7.4 million in 2026. So we see consistent downtrend of buying shares. Now, over the past few years, it's been pretty flat. So not as much capital is being given to or used to take shares off the table. So we see that with this data center investment happening, they're slowing this down. So this will continue because it's going down a little bit, but it's not going to go down a lot because a lot of that cash is going to be used for the data centers instead of taking shares off the table. So cash will be used to increase the value of the business through building data centers, and hopefully people who buy and hold, they'll benefit from that because the company will continue to have a return on investment that continues to grow. But just know that over the past few years, we're pretty flat. So downtrend, strong downtrend, but flat for the past few years. And I would say expect that for future years, at least for the next 5 years. Economic value added. Let's look at, for the money that they're putting into the business, the capital that they have on hand, what's their return on that capital, and compare that to the cost of capital. We want to know what's the spread of economic value added, and we compare that to the industry average of other software infrastructure companies. And we like the result. This is not the most amazing comparison, but we like it. So Microsoft is earning 28.7% on their return on capital. The capital that they put into the business, 28.7. Software infrastructure companies are averaging 29.3. So looks like they're losing. However, Microsoft has a lower weighted average cost of capital over the past 5 years versus the average of 9.3. So the 21.2 is a little bit over the industry average. So we have to keep this in mind. The way Microsoft runs their business is not necessarily the same as every other software infrastructure business runs their business, runs their operation. So there is some caveats when we're looking at this. This is just for kind of information, just to get an idea of how they're performing compared to their peers, understanding that they don't really have direct peers because of their business, of their business model. So that is something to keep in mind. We're not really making investment decisions off of this comparison, but I just like to know. So solid spread, creating value of 21.2% per year over the last 5 years as their average. With that said, let's go at the quick look at the valuation. Share price right now, $503.81. I'm projecting that the fair value of Microsoft is about $526. Potential upside of 4.5%. If you were like me and you're trying to be directionally accurate, it's not about an exact science. On the high range, 579. On the low range, 474. But I believe right now, in my opinion, it's a safe space as far as investing due to the Azure and the cloud revenue growing at a much higher rate than the rest of the business and projected to continue doing that for the foreseeable future. So with that said, I think 503 is pretty much right in the pocket of fair value. So one of the main issues or concerns with Microsoft and their revenue mix is OpenAI. They have a very tight relationship with OpenAI, and it's reported that a lot of the Azure and cloud revenue is coming from OpenAI. We're not exactly sure about how much the concentration risk is there, but some people have a fear of the concentration risk being there, meaning so much of your revenue is coming from one customer, it poses a risk. What happens to that one customer? If they change their mind, if they don't renew a contract, or if that company fails for whatever reason, that's a big chunk of your revenue that's going away. So there could be a revenue concentration risk with OpenAI. So that is something that you need to be comfortable with to, one, believe that this stock is fairly valued, and two, believe that this is a safe investment for you for the foreseeable future. So that's just one caveat of risk I wanted to put out there, just to make sure you're comfortable with that relationship and do some research there before investing in this company. So with that said, let me know what you think about this valuation in the comments, and I hope to see you in the next video.